finance, will you recommend the Job Guide 360 interview guide to prospective job seekers?
Sure, I will. The guide is detailed and very comprehensive.
Welcome to the deep dive. We take complex source material, stacks of it sometimes, and really pull out the essentials so you can get informed fast. Today, we're looking deep inside the engine room of modern finance. We're talking about the Financial Risk Analyst. These are the folks keeping banks, institutions, stable. They use these incredibly complex methods to try and head off catastrophic losses. So, our mission today, to take those really technical models and frameworks, value at risk, machine learning stuff, Basel III ratios, and distill them into insights you can actually use. Okay, let's unpack this.
It's a really fascinating area and crucial, like you said, because this role, it demands way more than just general finance knowledge. You need deep technical expertise and across such different kinds of risk too. Market ups and downs, credit defaults, sure, but also operational glitches and now these big ESG factors. Yeah, the material we look at really highlights that. You need that solid statistical foundation, absolutely, but also rigorous regulatory know-how, and maybe most importantly, the skill to see how it all connects. Analysts aren't just calculating isolated risks, they're managing the firm's whole interconnected web of exposures.
Okay, let's start with the numbers, the quantitative bedrock. Market risk, try and get a handle on volatility. The big metric everyone talks about is value at risk, VAR, right?
The VAR is definitely essential. It gives you a single, pretty digestible number, quick snapshot. So if an analyst says our one-day 99% VAR is $1 million, what they mean is they estimate there's a 1% chance the portfolio could lose more than $1 million in one day. Gives you a clear threshold.
Right, a threshold. But I gather VAR isn't the whole story. It tells you that you might lose more than $1 million, but not how much more. It misses that really bad day, that 1% event.
That's exactly the limitation. It doesn't capture what we call tail risk, those extreme, way out there losses. VAR kind of cuts off at that 99% mark.
So what do they use instead? Or alongside it, you mentioned expected shortfall.
Exactly. Expected shortfall, ES, or something that's called conditional VAR, CVRR. That tells you the average loss you can expect if you breach that VAR threshold. So if that 1% event happens, ES gives you an idea of how bad it might actually be. It's a much better gauge of the true worst-case scenario.
And they don't just rely on these numbers in a vacuum, right? They stress test, like throwing historical crises at the portfolio.
Oh, absolutely. Stress testing is vital. They simulate extreme market conditions. A classic one is running the current portfolio through a 2008-style financial crisis scenario to see how it holds up.
Okay, that makes sense for market swings. Let's pivot to credit risk, predicting who might default. The basics start with things like logistic regression.
Yeah, logistic regression is often the starting point. You feed it standard factors, credit scores, debt to income, payment history to estimate the probability of default. It's tried and tested. But what's really interesting now is the integration of machine learning. We're talking algorithms like random forests, gradient boosting machines.
Okay, hang on. What does a random forest model actually do differently? Why use that instead of the simpler regression?
Good question. It's about capturing nonlinear relationships. A simple regression might look for a straight line connection between factors and risk. Machine learning, though, can spot much more complex patterns. Maybe someone has a perfect score, but all their debt is tied up in one shaky sector. A standard model might miss that nuance. ML can pick it up.
And does it make a real difference?
It seems to. We saw data from one firm where a new ML-based credit scoring model for small business loans improved their default prediction accuracy by about 15%. That's significant.
Wow, 15% is definitely not trivial.
Not at all. Yeah. But there's a big but. Interpretability. Regulators need to understand why the model made a decision. You can't just have a black box spitting out answers, no matter how accurate. It has to be explainable and compliant with rules like IFRS 9 or CECL.
Right, the show your work aspect. Okay, third pillar, liquidity risk, cash flow resilience. If markets tank or defaults rise, can the institution still meet its obligations? How do analysts tackle that?
It's all about ensuring you can pay your bills without catastrophic losses from selling assets cheap.
Yeah.
The main tool is detailed cash flow forecasting. Specifically, they do liquidity gap analysis, looking for mismatches between cash coming in and cash going out over different time buckets like next 30 days, 90 days, 1 year out. The goal is to always have enough high-quality liquid asset stuff you can sell easily without losing value to cover those potential gaps.
And this ties directly into regulations, I assume. Basel III comes up a lot here.
Absolutely. That ensures you have enough liquid assets to survive a 30-day stress scenario. And the net stable funding ratio, NSFR, which looks at stable funding over a 1-year horizon.
And more stress testing here, too.
Definitely. They designed specific liquidity stress scenarios. What if our credit rating gets downgraded suddenly? What if there's a market-wide freeze on funding? All this analysis feeds into what's called the contingency funding plan, basically, the playbook for how the institution will get cash in a crisis.
Okay, so we've covered market, credit, liquidity, the big external risks, but analysts also look inward, right? Operational risk, failures in processes, people, systems. That sounds harder to quantify.
It is definitely less straightforward than market prices or credit scores, yeah. It takes a more multi-pronged approach. A key tool is the Risk and Control Self-Assessment, or RCSA. Basically, analysts work with different business units to get them to identify their own potential operational risks and check the controls they have in place.
So getting the people doing the job to flag potential issues.
Exactly. An RCSA might uncover, say, a weakness in how trades are manually handed off between teams, which could lead to errors. Then you can automate or add checks.
And they monitor this ongoing. You mentioned KRIs.
Right, key risk indicators. These are specific data points that act like early warnings. Things like system downtime frequency, transaction error rates, maybe even high staff turnover in critical roles. These KRIs, plus data on past operational losses, help inform scenario analysis for those really damaging but maybe infrequent internal failures, like a major system outage or internal fraud.
Which leads us nicely into stress testing and scenario analysis again. We've touched on it, but it seems absolutely central. How do they build these what-if scenarios, especially the really extreme ones?
It's a very structured process. First, identify the key drivers of risk, big picture economic things like GDP growth, unemployment, interest rates, but also firm-specific factors like the quality of their loan book or their reliance on certain funding sources. Then they develop scenarios. Some are based on history, the '08 crisis, maybe the Eurozone debt crisis, but others are purely hypothetical, designed to be severe but plausible.
Like what?
Maybe a deep global recession combined with a major successful cyber attack on the firm's core systems, or a sudden geopolitical shock that freezes international capital flows.
Okay, here's where it gets really interesting for me. The sources stress it's not just about testing one risk factor, but the connections. How a market shock leads to credit losses, which hits liquidity. Why is modeling those knock-on effects so vital?
Because that's reality. Risks rarely happen in neat little boxes. They cascade. A market downturn makes borrowers less likely to repay loans. That's market risk triggering credit risk. Then, as credit losses mount, the firm's perceived health declines, making it harder or more expensive to get funding now. Credit risk is hitting liquidity risk. Maybe it even triggers a ratings downgrade. Understanding and modeling that whole chain reaction is crucial for seeing the true potential impact. The results feed into capital planning strategic decisions. And it's a huge focus for regulators, too. Like with the Federal Reserve's big CCR stress tests in the U.S., they demand that integrated view.
Right. Now, there's a risk within all this modeling, isn't there? Model risk itself. The danger that your sophisticated models are just wrong. Flawed assumptions, bad data, incorrect implementation.
Absolutely. It's a huge concern. You need a really robust model risk management framework. That means strict processes for developing models in the first place. Crucially, it involves detailed documentation. What's the model for? What are its assumptions? What are its limitations? And keeping track of every model in a central inventory.
And the sources really emphasized independent validation. Is that just having another team double-check the math?
It's more than that. It's a separate team, independent from the model developers, really kicking the tires. They challenge the assumptions, check the data quality, scrutinize the implementation code. They use specific techniques, like running the model on data it wasn't built with that's out of sample testing or comparing its results to totally different benchmark models.
Trying to find the blind spots the original team might have missed?
Exactly. It's about ensuring objectivity and catching potential biases or errors. Plus ongoing monitoring of how models perform over time using key performance indicators. Regulators are intensely focused on this too. There's specific guidance like the Fed's SR 11-7 that lays out expectations for model risk management. You have to get it right.
Okay, so analysts are juggling all these models, frameworks, validation processes, and the rules keep changing. How do they stay on top of the constantly shifting regulatory landscape? Basel III updates, new data privacy rules like GDPR.
It's a continuous effort, frankly. It involves things like memberships in professional bodies. JARP, PRMIA are big ones. They provide updates and training. Subscribing to alerts and newsletters directly from the regulators, the Fed, the SEC, Bank of England, whoever is relevant. Attending industry conferences is also key for hearing interpretations and best practices.
And when a big new rule does land,
it triggers a major internal effort. Teams have to dive into the details, figure out the impact, coordinate across departments. Like with GDPR, risk teams had to work closely with IT and data management to ensure compliance wasn't just a policy, but embedded in processes.
That constant pressure seems to drive the need for risk integration, doesn't it? This idea of enterprise risk management, ERM, seeing the whole picture, not just the silos. You mentioned the interconnections market, credit, liquidity. How do they actually quantify those links?
That's where some quite advanced statistics come in. The source material mentions things like copula models.
Copulus. Sounds complex.
It is, a bit. But the basic idea is they allow you to model the dependency between different risks, even if they don't move in a simple linear way. So instead of just assuming, say, a stock market crash and a corporate bond default wave are separate events, you can model the likelihood they happen together and how strongly they're linked.
Ah, okay. So capturing that perfect storm scenario where multiple bad things hit simultaneously.
Exactly, which then feeds into much more realistic, integrated stress testing. You can model a scenario like a major cyber attack hits. That's operational risk.
Right.
That disrupts operations and maybe spooks funding providers, hitting liquidity risk. The disruption and bad press caused the firm's credit rating to be downgraded. Now, credit risk is involved. Modeling that whole chain lets analysts use integrated metrics, like economic capital, to estimate the total capital needed to cover all these combined risks. It gives a single measure of overall vulnerability.
Which is incredibly powerful. But all this math, these complex scenarios, it's useless if the board of directors or senior management can't understand it, right? Communication seems like a huge, maybe underrated part of the job.
Absolutely critical. You have to translate highly technical analysis into clear, actionable insights for people who aren't quants.
How do they do that effectively?
Analogies help a lot. Comparing VAR to, say, estimating the worst likely daily loss for your personal investment portfolio makes it more relatable. Visuals are also key. Charts, graphs, especially things like heat maps or traffic light systems, red, amber, green dashboards.
Right, so the board can quickly see where the big risks are concentrated without needing to parse pages of statistics.
Precisely. It's about storytelling with data. You don't just present numbers. You build a narrative. You explain how a specific risk, like that cyber attack scenario, could unfold and impact the bottom line, reputation, everything. Make the abstract feel real.
Okay, one last major area. The future, or at least the rapidly arriving present. Incorporating ESG factors, environmental, social, governance. This isn't just about doing good anymore, is it? It's a core financial risk.
Completely. ESG risks have tangible financial implications, and analysts have to integrate them into the standard risk frameworks. It's not optional now. Frameworks like the TCFD, the Task Force on Climate-Related Financial Disclosures, are becoming standard guides for how to do this, especially on the climate side.
So how does it work in practice? Are they adjusting those models we talked about?
Yes, exactly. For credit risk, for instance, an analyst might adjust the probability of default, PD, or the loss given default, LGD, for a company based on its ESG profile. Think about a company with very high carbon emissions in a sector facing stricter climate regulation. That's a quantifiable risk factor that needs to go into the credit assessment.
And this involves looking much further ahead than traditional risk analysis, doesn't it?
It has to, especially for climate risk. Analysts are developing long-term scenarios looking out 10, 20, even 30 years to model the impact of the transition to a low-carbon economy. What happens under different policy pathways? What's the impact of widespread carbon pricing? How do physical risks like extreme weather affect assets? It's fundamentally changing the time horizon for risk assessment. #outro. If we connect this to the bigger picture, the role of the financial risk analyst, it really boils down to critical thinking and synthesis. It's this constant process of connecting the dots, taking individual measurements, like a VAR number or an LGD estimate, and understanding how they fit into the whole institutional risk landscape. And always preparing for the unexpected, whether that's a market crash, an internal failure, or the long-term impacts of climate change.
So what does this all mean? We just heard how ESG integration requires analysts to model these long-term, decades-out scenarios, things like severe heat waves or aggressive carbon taxes. What happens to finance when today's most extreme, hypothetical climate scenarios start becoming the actual historical data that future analysts use to calibrate their baseline stress tests? It really shifts the perspective. It's clearly a role demanding constant vigilance and adaptation. We hope this deep dive into the tools, the models, the frameworks used by financial risk analysts gave you a clearer view of this vital, complex world. Thanks for joining us.